Institutional money does not sit still. A pension fund does not allocate to technology and leave it there forever. A sovereign wealth fund does not hold the same sector weights, regardless of what the economy is doing. Capital rotates continuously from sectors that are expensive and slowing to sectors that are cheap and accelerating. This rotation follows patterns that are surprisingly consistent across economic cycles. The sectors that lead early in a recovery are different from the ones that lead mid-cycle, which are different again from the ones that hold up as growth slows. Understanding the pattern does not require a macro degree. It requires reading the price action of sector ETFs relative to each other. AI turns that reading process from a time-consuming, multi-chart exercise into a fast, systematic analysis. Let me show you how. The economic cycle has historically moved through phases, and sectors have historically led and lagged in a consistent sequence. Early cycle, coming out of a recession, tends to favor financials, consumer discretionary, and materials. Interest rates are low, credit is expanding, and consumers are starting to spend again after pulling back. Mid-cycle, the healthy expansion phase, sees technology, industrials, and energy participate strongly. Business investment picks up. Companies are growing and spending on infrastructure and equipment. Late cycle, as growth peaks and inflation builds, defensive sectors start to outperform. Consumer staples, healthcare, and utilities offer earnings that are less sensitive to economic conditions. They are not exciting. They are safe. Recession, falling economic output, sees the full defensive rotation. Utilities, healthcare, staples. Cash is a sector position. Everything cyclical underperforms. This cycle does not proceed on a fixed schedule, but the sector performance sequence is observable in real time through relative strength analysis. AI can run that analysis across all 11 sectors simultaneously in seconds. Prompt 1 establishes the real-time sector performance picture. Use the sector ETFs, XLF for financials, XLK for technology, XLY for consumer discretionary, XLP for consumer staples, XLV for healthcare, XLU for utilities, XLE for energy, XLI for industrials, XLB for materials, XLRE for real estate, and XLC for communication services. Compare all 11 versus the S&P 500 using SPY. Use this prompt. Using the following sector, ETFs, calculate the total return for each sector relative to SPY over the past 1 month, 3 months, 6 months, and 12 months. Then rank all 11 sectors from strongest to weakest relative performance for each time period. Identify which sectors are in the top 3 across all 4 time periods, which sectors have been consistently in the bottom 3, and which sectors have seen significant changes in rank between the 12-month and 1-month periods, indicating either accelerating or decelerating rotation. Finally, map the current leadership pattern to the typical economic cycle phase it most resembles. The final question, mapping to cycle phase, gives you macro context for the technical rotation signal. When the data says financials and discretionary are leading, while utilities and staples lag, that is the market pricing in early to mid-cycle dynamics. That context should inform where you look for individual stock opportunities. The sector rankings produce 2 actionable insights: current leaders and laggards. The sectors in the top 3 across all 4 timeframes have sustained institutional buying behind them. Capital has been flowing there consistently. The laggards are where capital has been flowing out of. Those are the most reliable signals of where institutional preference currently sits. Rotation in progress. When a sector that ranked 8th over 12 months has moved to 3rd over the past 1 month, something has changed recently. Capital is starting to flow in. This is early stage rotation, the most potentially profitable entry point before the rotation becomes consensus. AI will surface these acceleration signals. Cycle phase identification. The cycle mapping tells you where we are broadly in the economic environment. If the market is signaling late cycle rotation, defensives outperforming cyclicals, you should be reducing exposure to economically sensitive stocks and looking more carefully at healthcare staples and utilities for individual setups. Prompt 2 creates ratio charts. The most direct way to visualize rotation between two sectors. A ratio chart divides the price of one ETF by another. When the ratio rises, the numerator is outperforming. When it falls, the denominator is outperforming. Analyzing the trend of the ratio chart tells you which sector is winning the capital flow battle in real time. Use this prompt. Using daily price data, calculate and analyze the ratio of each of the following sector pairs over the past 24 months. For each ratio, describe the trend direction and whether it has been trending, recently inflecting, or range-bound. Technology versus utilities, XLK/XLU. Consumer discretionary versus consumer staples, XLY/XLP. Energy versus real estate, XLE/XLRE. Financials versus healthcare, XLF/XLV. And industrials versus materials, XLI/XLB. For each pair, identify the trend of the ratio and the current position, and flag any ratios that have recently broken a significant trend line in either direction. These pairings are the classic cyclical versus defensive ratios. When XLK is outperforming XLU on the ratio chart, risk appetite is high. When XLU is outperforming XLK, investors are moving to safety. A broken trend line on a ratio chart is often the earliest signal of a major rotation shift, before the individual sector charts show anything dramatic. Ratio chart analysis tells you the direction of the flow, not just the absolute level. Trending ratios, a ratio that has been consistently rising for 12 months, tells you sustained capital preference, not a temporary shift. That sustained trend is what creates momentum in the leading sector. Identify the 2 or 3 ratios with the strongest trends and focus your stock level analysis in the winning sectors. Inflection points. The most valuable signal is a ratio trend that is breaking down after a long run. If the XLK/XLU ratio has been rising for 2 years and just broke below its 200-day moving average for the first time, that is an early signal that the technology outperformance cycle may be turning. The sector ratio breaks before the individual sector charts show the damage. Confirming your cycle view, the ratio analysis should confirm or challenge the cycle phase identified in prompt 1. If prompt 1 says mid-cycle and the cyclical versus defensive ratios all show cyclicals leading, the signals are aligned. If they conflict, dig deeper before acting. Prompt 3 moves from sector level analysis to stock level opportunity. Once you know which sectors are attracting capital, the next step is identifying the individual stocks within those sectors that are outperforming the sector itself. These are the stocks where the most focused buying is occurring, the ones that will move the most as rotation continues. Use this prompt. The leading sector has shown the strongest relative performance over the past 3 and 6 months. Now analyze the individual components of this sector using the top 20 holdings by weight in sector ETF. Calculate the relative performance of each stock versus the sector ETF over the past 1 month, 3 months, and 6 months. Identify the stocks that are outperforming the sector across all 3 periods. These are the internal leaders. For the top 5 internal leaders, describe the current chart structure. Are they in uptrends, at new highs, or pulling back towards support? Which of the five appears closest to a high probability entry based on technical structure? This two-step filter, best sector, then best stock within that sector, produces candidates with dual tailwinds. The macro capital flow is going to the sector, and the stock level fundamental story is strong enough to attract disproportionate buying within that sector. The sector to stock drill down gives you a prioritized opportunity list, dual outperformers. The stocks outperforming their sector in all three timeframes have the strongest combination of macro tailwind and company-specific strength. These are the highest conviction candidates for new positions. Chart structure context. Of the dual outperformers, the ones pulling back towards support within an established uptrend offer the best risk reward. You are buying a strong stock in a strong sector at a technically sound entry. The risk is clearly defined, the stop goes below the support level, and the target aligns with the sector rotation thesis. Laggards as avoids. Within a leading sector, some stocks will still underperform the ETF. These are the ones with company-specific problems. Avoid them even though the sector is strong. The rotation trade is not about buying the whole sector. It is about buying the leaders within it. The bonus move adds a dimension most rotation analysis misses: the flow between large cap and small cap within the same sector. In early bull markets, small caps often outperform large caps because risk appetite is expanding and investors are willing to take on more uncertainty for more return. In late cycle or risk-off environments, large caps outperform because capital moves to more liquid, more stable positions. This large cap versus small cap rotation often precedes the sector level rotation by weeks. Use this prompt. Compare the relative performance of the large cap sector, ETF, versus a small cap equivalent for the leading sector over the past 6 months. For example, for technology, compare XLK, large cap, to PSCT, small cap tech. Calculate the ratio and assess its trend. Is small cap outperforming large cap within this sector, suggesting early cycle risk appetite? Or is large cap outperforming, suggesting late cycle safety preference? Then compare this to the overall Russell 2000 versus S&P 500 ratio to see if the within sector pattern matches the broad market pattern. When small cap tech is leading large cap tech, risk appetite within technology is high and early cycle dynamics are present. When the pattern reverses, large cap leading, capital is consolidating into the safer, more liquid large caps within the sector. That is a warning sign. Even in a nominally strong sector, sector rotation is not a theory. It is observable, repeatable, and analyzable in real time through price data. The patterns do not repeat with calendar precision, but the sequence of leadership across the economic cycle has been consistent enough to provide a meaningful edge. Prompt 1. Current sector rankings. Rank all 11 sectors across 4 timeframes. Identify sustained leaders, persistent laggards, and sectors showing acceleration or deceleration in relative performance. Prompt 2. Ratio charts. Map the cyclical versus defensive relationships to understand the direction of capital flow and identify inflection points where a long-established trend is beginning to crack. Prompt 3. Stock level drill down. Within the leading sector, find the individual stocks outperforming the sector itself. The dual outperformers with both macro and micro tailwinds. Bonus: large cap versus small cap within sectors. Understand whether risk appetite is expanding or contracting within the leading sector itself. The market is always telling you where the money is going. Sector rotation analysis is how you listen. Next episode, building a technical watch list. how to systematically screen hundreds of stocks for the setups that meet your criteria without spending 12 hours a day in front of a screen. See you Thursday.